All right, it's time to let loose and talk about what we think is important in the world of finance. Joining me to do just that is my good friend, Brian Sozzi, founder, CEO, and chief equity strategist for Bellis Capital Advisors. Brian, welcome back. It's great to see you.
Yeah, thanks for having me on.
So I want to start off with the main story that continues to dominate the tape, the Federal Reserve, right? Bernanke wasn't kidding around when he testified back in May on Capitol Hill that the Fed could begin to dial back its bond purchases later this year. You think that's the right policy prescription?
I don't think we have a choice. I think as investors or even as strategists, we have no choice but to sit back and watch this stuff play out. Why? Because none of it has happened before. The Fed has pumped its balance sheet over $3 trillion. That's fact. Fact is, they have to start putting out feelers in the marketplace to what the market's reaction could be. How they do that, they're going to do it through communication. And the problem that I see is that Bernanke has so far led, or he's wanted to increase the transparency of the Fed, but he came out, he said one thing, and then his boys tried to clean up the mess. And it hasn't worked. It's been a failed strategy.
Yeah, it's been damage control. It's like there's too many cooks in the kitchen. Exactly,
that's right. And much could be said. We were talking back in one of our geeky pre-meeting conversations. Yeah. Much could be said for Greenspan ruling the Fed with an iron fist.
Maybe they should stop talking, right?
I think they should stop talking, or at least come to some sort of cohesive opinion to express to the market, because all they're doing is creating inefficiencies in stock prices.
Well, isn't that where the opportunity comes in, though, Brian?
You would think, and that's how we've been trained to think in terms of investors and strategists. But stocks continue to act very negatively to any hint of quote unquote tapering. So it tells you that there are efficiencies in the marketplace, but the market can care less because it's still going to price it into the downside.
Well, I got to tell you, I think that rolling back QE is the smartest thing I've heard in the past 4 years. I mean, at this point, it's not working. It's not helping the recovery. I think it's merely manipulating asset prices. It's causing stocks to run far ahead of the fundamentals. I think within the Fed, they know that they've become so far ingrained within the bedrock of capital markets that QE in some ways is a trap. And if they don't pull back, now it's going to get even worse going forward.
Oh, no, totally. And I cringe when I hear strategists use this hooked on drug methodology, this approach regarding QE, but it actually makes sense. We don't know how the market is going to react as this stuff is around over the next 2 to 3 years. We've never been put in this type of position.
It's going to be so messy. It's going to be so messy.
It's very messy. But if you look at companies, we've gotten a subpar recovery relative to post-World War II periods. 2.5% growth, that is good. Supposedly, the Fed has created 2 million jobs as a result of QE going back to 2009. They put out a study. But there just should be a lot more economic activity given what they've done.
Do you buy that number, though, the 2 million number?
It could be a little fakish. I don't know where they necessarily got it. I try to sit down and think strategically about it. Sure, they've created construction jobs, which creates manufacturing jobs. But I still see, the U6 unemployment rate is still over 14%. So, ¿qué pasa? What's wrong?
Yeah, no, I completely agree. I think that actually, though, by ironically ending QE, you could actually open the door to economic growth because you can unlock credit, right? If you look at the modern day economy and the way credit is created, a lot of it is through financial institutions that use treasuries as collateral, right? The very securities that the Fed has been buying up in $40 billion worth per month, they use that as collateral to make loans to Main Street, right? Whether it's mortgages, credit cards, business inventories, you name it. And I also think that if rates are allowed to increase, as we've seen in the past couple of weeks, even though it's been a slight uptick, that could help net interest margins. And that could encourage banks to lend a little bit more because those loans are going to be more profitable.
All right, I will push back a little on that. You're my girl, but I will say that many companies have underinvested in their businesses. And one of the key points Alan Greenspan has made probably over the past 2 years that despite low interest rates, capital investment has remained very low. So what happens if rates start to go up? Companies may be disinclined to invest even more in their business, try to suck more blood out of their assets. And number two, remember, what happens when rates go up? It's going to cost more to roll over debt. And I think that's very important when you're looking at investing in industrial companies or even utilities.
All right, well, we'll leave it there. We'll agree to disagree. But speaking of speed bumps, right, second quarter earnings season is upon us, and profit margins are at 58-year highs. Brian, this is something you and I have talked about for 3 years now. Do you think earnings are finally near a peak? Does it matter if companies have sufficiently guided down and recalibrated expectations?
The strange thing, and I get this question a lot from clients, well, how do I think about earnings season? It's hard as a strategist to do this now because in the back of your brain, you're wondering about the Fed. So if a company comes out and they lower guidance, but in the back of your head, you're saying, hey, the Fed is there to mop all this up and to save my behind in terms of making a stock call. But I am concerned about the quality of revenue growth that companies are reporting. I think they're having to lower prices throughout the globe. Great example, Walmart. Walmart is investing almost billions and billions of dollars to lower prices all over the globe. That is not normal. That shouldn't be happening in a normal recovery. Now, coming into the earnings season, we've already started to get earnings warnings. So I think if you look at those warnings and you project out to see who else can do it, like say a DuPont, what they came out and said, you're worried about how earnings season is going to take shape.
Yeah, no, I agree. But at some point, I would think that the quality of earnings would matter. But let's shift gears. It's now time for what I'm calling the tech smackdown, right? It is Apple versus BlackBerry. Brian, who wins this? I don't even think this is even fair. This is your idea, though.
All right, you would think it's not fair, okay? But Apple has been in the dog pen for many months on end, has underperformed the NASDAQ for months on end. BlackBerry got destroyed on its earnings report, 30%. I didn't like the stock coming into the quarter. Actually, going back to March, I hated it. But I think obviously Apple's the one. I think Apple's obviously the one to own here, because you're going to see the sell side get a little more enthusiastic going into the quarter. They're coming into their product release schedule. That's good. You're also, I mean, in terms of BlackBerry, you're having many heroes out there trying to pick the bottom, saying, 52% of their market cap is in cash. Good, keep it. I don't want any exposure, because I think they're going to blow through that cash as they try to regain market share.
I got to disagree with you on both. I would not own either names here. I mean, it's clear BlackBerry is irrelevant. I mean, they talk about on the street, spin off the software part of the business, and then BlackBerry could sell that to Apple or Google and those devices. But I think that Apple and Google have cornered the market already. I don't think BlackBerry stands a chance. And on Apple, I mean, this is, to me, a show me story right now. And a lot of eyes are going to be on the fall. I think investors are going to breeze past the second quarter, the current quarter earnings, and look to what's on deck as far as product launches are concerned. And if the products fail to impress, I think the stock's going lower.
Hey, you're right. Okay, I will go there. I did not see that coming. But if I had to jump outside of those two names, I'm going with eBay. The stock has been destroyed over the past 2 months. I like what they're doing on PayPal. I like what they're doing in their core business. And if I want to look at tech and if I can get something at a cheaper valuation, eBay would be the name. But gun to head, Apple or BlackBerry, you got to go Apple, because BlackBerry can go out of business over the next
All right, well, gun to head, yes, Apple. But I got to say, I really like Google here. I think that when it comes to the smartphone wars, software rules the day, and Google is winning that right now.
I can dig that.
All right, well, let's switch gears for a hot second, talk about Facebook stock, which has been not so hot as of late. Stock seems to be stuck in second gear here, Brian. What gives?
What gives is there's just so much going on. And we talked about this, but much could be said, I think, for social media simplicity. Twitter is still the same as it was a couple years ago. LinkedIn has made little changes here and there. And I think their user experiences as a result of that simplicity are great. What is Facebook doing? The news feed is getting so complicated. Every time I post a picture, I get 100 options.
Yeah, I'm getting lost on there now.
You have to be unemployed just to maintain your Facebook page. And if you want to cut right through the numbers, and if you want to be bullish or bearish, why I'm bearish is because look at the average revenue per user. Where it's growing for Facebook around the globe is in those areas where they can't generate much revenue per user. Yeah, I think it's a big, serious red flag.
Well, I think at its core, advertisers are still a little bit skeptical about whether their ads are translating to sales. I think Facebook's going to need a lot more time in terms of proving to the market that they can monetize in a big way on mobile. But what gave me pause recently was a report out that Mark Zuckerberg is contemplating changing up the news feed so that it is now the go-to place for where people read the news. And to me, that's a red flag, because Facebook is a place where you go to socialize with your friends online, and that would alienate the core user.
Well, think about it this way, and I'm not a tech geek, I'm very much old school, but why are they doing the news feed? Because they want to sell, they want more eyeballs there. They want that to be your go-to destination, so they can go take that package, those eyeballs, those numbers, and go to advertisers and make more money. But I think to do that, they're going to upset the user experience. They're going to upset people like us that have grown up with Facebook as a place to go hang out and socialize and get off, not to ultimately consume your life.
Finally, Brian, you're seeing an interesting trend that's reinventing online retailing you call microsites.
Yeah, microsites. We've been out talking to a lot of executives, and there's only seem to be two companies doing this. One I'll highlight is Best Buy. Microsite is essentially a shop and shop, but online. I think that's the next big wave in online retailing, where companies like a Best Buy and even a Dick's Sporting Goods, the two companies doing it, are going to showcase their best possible products in one confined area on the site. It makes great sense for both the vendor and the retailer.
All right, good talk, Brian. Thanks so much. Great to see you. We'll see you soon.
Thank you.